Wall Street rattled by a weak jobs report. The U.S. economy shedding 92,000 jobs in February. The unemployment rate ticking slightly higher to 4.4%. Joining me now, Apollo Global Management Chief Economist Torsten Slok. Torsten, thanks for coming by. Good to see you again.
Thanks for having me.
So this number rattled Wall Street. Most people weren't too happy with it. You say you're actually not worried.
Well, if you look at how markets reacted to the number, it really reveals that the market did not interpret this as bad news as such. There are some important details when it comes to why the number was so negative as it was. First of all, there were some issues with weather. There were some issues about a strike. And there were also some issues about the net birth death model, meaning how new businesses are calculated in terms of how they drive or initiated in the U.S. economy. So there were some technical things that basically are telling you that the market's reaction is indeed the interpretation that this was not as bad as the headline number itself would suggest.
And you've seen some leading economic indicators you've pointed out that suggest maybe some signs of life in the jobs market, but also, and people should know that every day in our inboxes we get the daily spark from Torsten Slok with these charts, and one of them was also on labor supply, which you said is changing with immigration.
Absolutely. So we do have a very unique situation where immigration has slowed down from around 3 million per year from 2022 to 24, and now immigration at the moment is only around 500,000 per year. And combining that with the stronger tailwinds to the economy coming from the One Big Beautiful Bill, that's going to add 0.9% to GDP growth this year. We also have strong tailwinds to growth coming from AI and data center spending. We also have a strong tailwind to growth coming from the industrial renaissance, meaning that we are homeshoring, onshoring a lot of production in pharmaceuticals, semiconductors, defense. All those things argue for why the economy for the rest of this year should continue to do well. So we do not view this number as a sign that the economy is slowing down. On the contrary, a lot of other indicators, ISM for services, ISM for manufacturing, and the broader picture points to an economy that's actually still going to do better over the next several months.
If the economy is pretty strong, the labor market is better than today's number, Friday's number suggested, and inflation is still, printing well above target, that sounds to me like it's not a rate cut environment.
Well, that's why the challenge is exactly as you're saying, Jack, that at the moment, the latest inflated data we have is that inflation is 3.0. The Federal Reserve has the target that inflation should be 2.
Wow.
And given 3 is not 2, that means that it becomes difficult for the Fed to cut interest rates because inflation is just too high. So yes, the number today, of course, we are paying attention to what's going to happen over the next several months. But the conclusion is, if this is just a fluke in data sense, then we will still expect to see more growth over the next several months. And that should argue also for a situation where it becomes very difficult for the Federal Reserve to cut interest rates.
All right, let's talk about markets. You're not completely happy with some of the stuff you're seeing in the markets. Not necessarily an indication that you're going to see the market go down, but you said that the tail risk, that's economist talk, has increased a little bit because of various interesting stuff under the hood. Let's start with margin debt.
Yeah, so we have a quite unique situation that the economy is good. That's still our conclusion, and that's still how we see it. That's not only how we see it, that's how the Federal Reserve is seeing it, that's how the consensus is seeing it. But if you look at markets, we've had some very interesting developments, namely that Magnificent Seven have started to underperform. Margin debt is very, very high, and at the same time, while the Magnificent Seven has been underperforming, because of AI suddenly now also becoming a theme, we've seen volatility in the index of the S&P 500 remain very, very low because there's a lot of passive money that continues to come in every month and just buy passively the S&P 500 index. But if you look under the hood at individual components, individual companies in the S&P 500, you're beginning to see much more volatility. Why is that? Because the market is literally every day trying to figure out, well, what sectors is it that are going to benefit from AI? Is it the sectors that are benefiting? Is that software? Is it not software? And while the market is trying to figure this out, you have significant volatility in the individual components of the index. So it's created a very unusual situation that high margin debt, a lot of people have borrowed a lot of money, and at the same time, volatility low for the index, but very high for the individual components of the index. That's setting us up for a situation where we are beginning to worry about a more vulnerable environment for the index, because it can't be right that the index has low volatility and the components have high volatility.
And just to explain real quick, with margin debt, the concern is that while that can juice you on the way up, it can accelerate things on the way down. Before we go, another debt question for you. Private credit. We don't talk about that too much in the show because not all of our investors are there. But Mohamed El-Erian recently said that it could be a canary in a coal mine. Some of these problems we're seeing in the private credit market. Apollo has some exposure there. Are you concerned this is a systemic issue or just a few companies having trouble?
Well, one way to look at that question is to look at what's going on with the default rate for high yield, what's going on with the default rate for loans. Those are types of assets in public markets that are generally lower rated, with companies that generally have lower credit quality? And the answer to that question is default rates for both high yield and loan have been going down for the last 9 months. So this is also consistent with the bigger picture we just talked about, namely that the economy is actually getting better. If it were the case that there was a credit cycle where you would begin to see more problems in terms of credit, then you would expect to see default rates going up, but that's not what's happening. Default rates for both high yield and loans have been moving lower. So the answer is we do not see this as the beginning of a credit cycle. This is very idiosyncratic issues. Instead, the economy continues to look good, and we expect that to continue.
Let's hope so. Torsten Slok, thanks very much.
Thank you.